Welcome everybody. This is our Crush the Market with Options presentation. I am going to try to keep things on time and get through this fairly quickly. We don't have a lot of time, but what I want to talk to you about today is, are a couple of basics when it comes to options, but that's really all you need when you're trading options. There's a lot of different option strategies out there, and some fairly sophisticated. I prefer to keep it simple, and so I wanted to go through just a couple of those with you today. I think it'll really help you out. Before I get to that, just want to remind you, as Renee said, I'm Vince Vora. I'm the head trader here at Trading Wins, and I have been doing this for about 30 years now, a little over 30 years actually. That's me in the bottom right if you've never had a chance to meet me. And in today's presentation, as I mentioned, I want to start with the basics. I want to talk a bit about who actually makes money in the market. Is it option buyers? Is it option sellers? We're going to go through that and then go through a couple of different strategies with you. And hopefully we'll have some time for Q&A at the very end. Please do remember that trading can be risky, so please don't trade with real money until you are completely comfortable with the system that you are using. Now, when it comes to the basics, let me just put up the definition of a call option, which is, as the buyer, you get the right, not the obligation, to buy a specific stock at a fixed price known as the strike price, any time between the date that you buy it and the expiration date. Okay. The option seller, however, is going to be obligated to sell you that stock at that price if you decide to exercise that. Now, more importantly, what's your risk and what's your potential reward when you buy a long call contract? Well, your your potential profit is unlimited because that underlying instrument, that underlying stock, can continue to go up. So it's really unlimited, but your loss is always limited to the amount of premium that you pay for that call. We're going to talk about how the premium is calculated and how you would figure that all out. But remember, as a buyer, you only risk what it is that you pay for that position to begin with. You cannot lose any more than that. A very, very important point to remember. When you are shorting a car, when you're selling a call, your profit potential is limited to the premium you receive for the sale of that call. So it's pretty much the opposite. While your potential loss is unlimited because, once again, that underlying stock can continue to go up. When I bring up my charts and show you an option chain, if you don't understand this now, it'll all come together when we show you the option chain. Now, on the flip side, there are put options. And what do put options do? They give you the right, again, but not the obligation, to sell a stock at a fixed price, once again known as the strike price, anytime between the date of purchase and that expiration date. As the put option seller, you would be obligated to buy the stock at that specified price if the other party decided to exercise that option. So when it comes to potential risk or potential reward, once again, when you buy an option, your risk is only the amount that you paid for that particular contract. While your profit here increases, it is limited in a sense because the stock can only go to zero, can't go below there, but it can be substantial and will increase as the price of that stock heads towards that 0 point. As a short put investor there, if you're selling the put, once again, your profit is limited to the amount that you receive for the sale of that put, but your potential loss can be substantial and it will increase as the price of that stock heads low. Okay. Now, how do we calculate options premium? Well, what is options premium? Options premium is the cost to you to purchase that contract, okay, or is the money you collect when you sell that contract. And the way you calculate it is this: one option contract is the equivalent of 100 shares of underlying stock. So if we were buying one call option and the price of that option was $1.50, the way we would calculate it is 1 times 100, okay, because one contract is the equivalent of 100 shares, 1 times 100 times 150. So your cost to purchase that one call option would be $150. And again, if you're buying, that would be your total risk, your absolute total risk. There is no way, no matter what happens with that position, there is no way for you to lose any more than that $150 maximum, okay? Now, what type of options can you buy? Well, there's thousands of stocks, optionable stocks out there. And nowadays, there are not only monthly expiries, but also many weekly expirations, stocks with weekly expirations. We'll get to a bit more of that a little later on. But there's also options you can buy on the index charts, like the S&P, the SPX, like the Dow, the NASDAQ, etc., or also on futures, crude oil, gold, other commodities, wheat, coffee, orange juice, just about any other commodity out there has options that you can buy in it. So really, it's it's fairly unlimited when it comes to options. Now, there's a few terms that you should be familiar with, and one of them is ITM, which is in the money. What this means is that the strike price of whatever call you're considering is below the actual market price of that underlying stock, okay? That's why it's known as in the money. So for example, if Apple, for example, is trading at $100 a share, and you buy the $90 call option, that means you are in the money, because your call option strike is actually lower than what the current market value is of that particular underlying stock, all right? And it'd be known as being $10 in the money, all right? Now, out of the money is the exact opposite. It means your strike price is further away from or above that current market price. So if we bought the 110 call and Apple was trading at 100, we'd be $10 out of the money, okay? For puts, it works the opposite way. If we were buying a put on Apple when Apple was trading at 100, the put that is above that strike price or the current market price would be in the money. So a 110 put would be $10 in the money, while a 90 put would be $10 out of the money. Now, there's also ATM, or at the money. That means the strike price that is closest to the actual current market price. All right, so a $100 call or a $100 put when Apple's trading at 100 would be the at the money strike. Okay. Now, a few other terms that you should be familiar with. One is intrinsic value, and the other one is extrinsic value. For every option contract, that premium, the price that you pay, is a combination of intrinsic value and extrinsic value. Okay? The intrinsic value is the in the money portion. Okay, so using that same Apple example, if we had bought the 90 call and Apple's trading at 100, so we were $10 in the money, but we paid $12 for that call option, then our intrinsic value, our in the money portion, would be the $10 in the money, and the $2 would be extrinsic value, the out of the money portion, which is also known as time value. So the further away the expiration date, or the longer time period to expiration, the higher the time value component is. Okay, so you're going to pay more for every bit of time that you buy. So if you buy an option that's 30 days out, you might pay an extra $1 for that option. If you buy 2 months out, you might pay $1.50 or so. You buy 6 months out, you might pay $4, right? It depends, but the extrinsic value is the time value portion, or the out of the money portion of that option. Implied volatility, that's the estimated volatility of that underlying security. In our example would be Apple. So when Apple fluctuates back and forth, that's what is referred to as the implied volatility. Now, normally what happens to volatility is it will decrease during times where the stock is going up and increase during times when the stock is going down. And the main reason is the common belief that bearish markets are more risky. And that's really because when stocks drop, you know, panic sets in at some point and the selling accelerates, right? Everyone's looking for a quick way out. They sell and that move lower gets exaggerated. So because of that panic feature, what you're going to see is volatility will spike when the market is selling off or when that particular stock is selling off, as opposed to when it's going higher, everyone's calm, right? Everyone's happy when stocks are going higher, and there's a lot less volatility or a lot less fluctuation with the price of that underlying. Okay, a few facts here before I get to the strategies. Options are really only risky if you don't know how to trade them. You know, at first I started out trading just stocks many years ago, and all I heard in the media about options was how risky they were and how careful you should be with them. But once I actually learned how to trade them, I realized that they are much safer to trade than just trading stocks. So when you know how to trade them, they're actually extremely safe to trade. And when I show you the couple of basic strategies today, you'll understand why they're a lot safer than just trading stock. Now, another fact is that over 80% of all option contracts expire worthless. That's a fact. And this, though, creates opportunity for option sellers, which I will talk about in a little bit here. But the real problem, or the real mistake that most option traders make, at least most new option traders make, is that they buy options and they do so without taking fair value or implied volatility into consideration. So what ends up happening is they'll end up guessing the direction of that stock correctly, but because they're not taking fair value or implied volatility into consideration, what they're actually doing is they end up overpaying for that option. So even though the underlying stock ends up moving in the direction that they thought it would move, they still end up losing money because they overpaid for that option to begin with. So these are items that you do need to understand and take into consideration when trading options. So even if you're just starting out or don't know much about options, I highly encourage you to get educated on them, because they really will make your trading a lot easier, a lot more consistent, and you can really leverage the amount of profit you can make without putting in a lot of money at all. It really requires a very small amount of money. Now, earlier, excuse me, I talked about, or I mentioned that I would talk a bit about who actually makes money in the markets. Well, let me show you the probabilities and how this works. So when you're buying a call option, remember that you can only lose what you pay for that particular contract. But regardless, when you buy an option on a stock, or you're expecting a stock to go up, only 5 scenarios can happen, okay? The position can move in your favor big time. It can move slightly in your favor. It can do nothing. It can consolidate sideways and just remain flat for a period of time. Or that position can go slightly against you, or it can go against you big time. Those are the only 5 scenarios when you're buying, okay? But here's how it results, or here are your probabilities of actually making money when you're buying an option. Obviously, if the position moves in your favor big time, you will make money, okay? Now, if the position moves in your favor slightly, it really depends on that fair value and that implied volatility component that I talked about. If you were able to understand those and not overpay for that option, then yes, you will make money if you buy a fairly priced option. But if you overpay, even when the position goes slightly in your favor, you will end up losing money. Now, when you buy an option and the underlying goes flat for a period of time, you'll definitely lose money. Why? That's because of that time value component. Remember, each option contract is made up of an in-the-money portion and an out of the money portion, otherwise known as the time value. So as every day goes by that you're holding it, but the stock isn't moving, you're getting closer and closer to the expiration date of that option, which means the time value is eroding, right? With every day that goes by, you have less and less time value. You're actually losing money every day you're holding that option without the underlying going in your favor, okay? Now, if it moves against you slightly, you're definitely going to lose some money. And if it moves against you big time, you will definitely lose money. So even if you take fair value and implied volatility into consideration, when you're buying an option, you really have a 2 out of 5 chance of making money. And if you don't know how to value an option accurately and you overpay, you really have a 1 out of 5 chance of making money when you're going long option. That's because it's a fact, over 80% of contracts expire worthless. Okay? Now, when you're selling options, the same 5 scenarios can take place. The underlying position can move in your favor big time. It can move in your favor slightly. It can do nothing and move flat for a period of time. It can go against you slightly, or it can move against you big time. Here's the difference though. If you sold an option and the underlying moves in your favor big time, of course you're going to make money. Even if it moves in your favor slightly, you will make money. Okay? Remember, when you sell it, okay, if you sold it when it was overpriced, even better, right? You're collecting that premium. So it's opposite of what the buyer scenario was. So you're still making money. Now, if it goes flat, if the underlying goes flat for a period of time, what happens? You're making money. Remember, the time value portion of that option is slowly eroding. With every day we get closer and closer to expiration, the value is dropping. And that's exactly what you want, because you sold that option, you collected that premium. Now what you want to do is you hope that it expires worthless so you can keep all of that money, or, you know, worst case, you want to sell it at a lower price than what you bought it and keep part of that premium, right? So the longer the time goes by and erodes without the stock actually moving anywhere, you're actually making money, because at least the time value portion of that option is shrinking in your favor. Now, if the underlying goes against you a little bit, you'll still make money. And that's both a combination of that implied volatility and fair value component that most traders do not understand well, and that's why most contracts expire worthless. About 80% of them do. But also, it's the placement of that sell strike, and we'll get to more of that when we get deeper into this. But if that position moves against you big time, then you will lose money. So look at the flip side here. When you're selling options, even if you really don't understand fair value and implied volatility, you're usually going to make money 4 out of 5 times. Remember that 80% of option contracts expire worthless. So 80% of the time, you're going to keep your money, you're going to collect that premium and be able to keep it. All right. Now, the time decay chart is very important to understand. If you're a buyer of options, you want the time value portion of your option contract, or that extrinsic value portion, to erode very slowly, right? You want the max amount of time. So if you look at the slope here, this line here that the arrows are pointing towards here, that's the pace at which the time value normally erodes on an option. So if you see from 120 days to 90 days, there's a very slight erosion, right? And then it starts to accelerate and accelerate. In the last 30 days, it really erodes very, very quickly. Okay? So if you're a buyer of options, what you want to do is buy 90 days or more to expiration, so that if right after you buy that contract, the stock kind of goes flat for a little while, or takes a break, or moves against you slightly, you're not going to lose all that much time value. On the flip side, though, if you're a seller of options, you want that price of the option to drop as quickly as possible. So you want that time value component to erode as quickly as possible. And so you want to buy or sell options that are about 30 days to expiration, maximum 40, no more than 40 days to expiration. All right. So there are many option strategies out there. We're going to talk today about long calls and puts. And if we have a bit more time, a couple other things, but they really range from the very simple to the very sophisticated. And the key, though, is to understand when and how to use each one of these. More importantly, you don't need to use them all, okay? You only need to trade the ones that make you money, meaning pick one or two, start with the very simple ones, hone your skills, and really focus on those. And when you're making money consistently with those, then and only then do you want to start learning other strategies, all right? Let's start with the first one. How many of you would like to buy shares of Starbucks here for less than the price of an actual coffee? In fact, you can pick some up for less than $1. And let me show you how. Let me bring up my option chain here, or my chart. Now, this is a chart of Starbucks, and lately it's been dropping, right? But let's say that we look at this chart and we say, well, you know, it's about to run into support, probably going to bounce and go higher from here. If we look at the longer time frames, you know, it's been on a nice trend. Here it is. It's coming back to support. It's going to bounce and go higher here. So we want to buy some Starbucks. Well, let's go to the option chain. And remember, if we're a buyer of options, what we want to do is go further out, right? We want to go 90 days or more. While the first expiration, that's 90 days or more, is January, with 134 days to expiration. Now, if we were just going to buy the stock is trading over $53 a share. That means for us to buy a lot, for us to buy 100 shares, it would cost us $5,300. Okay? And that's the amount of risk we'd have on the table, because you never know when or if the stock can go to zero. Now, realistically, it wouldn't go to zero, but you know, aside from using the stop loss, there's really no other way to protect yourself, right? Unless you combine it with options. Now, if we just want to use options, if we have a very small account, okay, have a look at this. We can go out to January and look at the $57.50 strike here, and we can pick this up for under $1, 87.88 cents per contract. Now remember, how do we calculate this? If we're buying one contract, it's the equivalent of 100 shares. So 1 times 100 times that 0.88. What does that work out to? $88, right? Big difference, is it not? We're still controlling, but 100 shares, the equivalent of 100 shares. But in one scenario, we're paying $5,300. Another scenario, we're paying $88. Remember, the maximum you can lose when you're going long an option is the cost of that option. So $88 is all the risk you have on the table. And that's if your option goes to zero. Okay, so now the difference is the delta. You know, when you own the stock, if the stock goes up $1, you make a full $1 in profit. Here, the delta is 26, which means that if Starbucks moves up $1, you'll make about 26 cents here move, or $26 with a contract, right? So yes, you're making less, but you're risking a heck of a lot less. Okay, so when you do it on a percentage basis, it really works out in your favor. Now, if you want to buy the stock, one of the ways you can protect yourself, really protect yourself, is to marry a put with it. Okay, so here's a way to buy Starbucks, the actual stock, without risking any more than what you would when you're just buying a call option. Okay, so if I bought the stock at $53.34 here, and then I went and paid $5 here for the 57.5, my cost would be the $53.34 plus 5, right? So my cost would be about $58.40 or so, right? $58.34, around there. So But I have an exit at 57.5 because remember, the put gives me the right to sell my stock at the strike price, 57.5, anytime between when I buy that position and expiration, which would be 134 days from now. So I can hold this position, and no matter what happens to the stock, I have an exit at 57.5. So obviously, if it goes up, I'm not going to exercise my option, not going to sell it at 57.5. But if it goes down, I can just continue holding it until expiration, waiting for it to turn around and go back up, because no matter what, I have an out. But if we get to expiration and the stock hasn't bounced and it's lower, I exercise and get out at 57.5. So if my cost was 58.34 or so, and I exit at 57.5, what's my risk? About the same, 88 cents or so, right? 87, 88 cents. So, and that's another thing. When you want to look at an option chain here, if you want to know what you're risking, if you're buying a stock and marrying a put to it, just look across the aisle here and look on the call side and for that same strike. And usually the price you see of that call is about the same amount you would risk by combining the put and the stock at that strike. Okay, a neat little trick there to do the math very quickly. But you can see that you can control 100 shares of Starbucks for about 88 bucks, right, in total. So you don't need a big account to do this at all. And it's very, very safe when you know what you're doing. Okay. Now, remember I said earlier about fair value and implied volatility. Well, if we collapse the option chains here, this is the Thinkorswim platform. But if you look to the right here, this is the implied volatility number. Okay. And you notice how they're all within a range, sort of 18 to 21, 22 or so. So high teens, low 20s, that's a range. So those are fairly priced for this particular stock. If we were to see one of these series move higher, so for example, if we saw the next week's expiration with 8 days to go, move up to 30%, that would mean that it's expensive, right? It's overvalued compared to the average here. On the same token, the flip side, if it was down at 8%, it'd be undervalued. That's the way you can look at that, okay? And that takes me to my next strategy here, which is trading it with earnings for earnings season. A lot of people like to pick up some options the day before earnings or the day of earnings on a stock because they know it's going to gap one way or the other, and they want to try to guess the direction and make a quick buck doing it that way. And the reason why most people lose big time when they do that is because of this implied volatility component. What you're going to notice is stocks that have earnings coming up, for the expiration that's just after the earnings, as you get closer and closer to that earnings date, you're going to see a spike here. Here, I have a couple to show you. There's a couple of stocks that have earnings coming up. This one is this Friday, KR. Okay, not a big name. And you can see that normally the implied volatility on this, right, is in around the 50 range on average, 40 to 50. And now tomorrow's expiration is 148%. So you see how we've spiked there? Well, if we were to buy a call today on this, we'd be way overpaying if we bought that particular strike, okay? So we'd be way overpaying. And what happens is, as soon as they announce earnings, this implied volatility will fall back in line with the average. So it's going to go from 148 down to 50 something or so on, right? So all of that implied volatility, that value, you're going to see your option premium drop by the same amount. So even if the stock gaps in your favor, your premium price is going to drop big time because of the volatility dropping back into the normal range. And that's why a number of people get surprised and lose money when they're buying on earnings. What you want to do is go to the chart and say you have earnings coming up around, well, let's go to the daily chart here. So you want to find stocks that move ahead of earnings. So if you look back in here, right, it moved nicely. You look back in here, it moved nicely, etc. But what you want to notice is that the move tends to happen about 2 to 3 weeks before the earnings date, right? And so what you want to do is whatever strategy you're using to pinpoint an entry on a stock, you want to identify those earnings dates and you want to make a note in your trading journal, and 2 to 3 weeks before, look for a proper setup. Because not only will you make money if it moves in your favor heading into that earnings, but because of that implied volatility spike, you're going to end up making a lot more. And so what you want to do is carry it into earnings and then get out of it the day before earnings. So you're not actually in for that gap on earnings, but you've made your money into it. And even if you get in long, let's say here, 2 to 3 weeks before, as the implied volatility is spiking and the position goes against you, your loss will be even less because the price of that contract is going up in anticipation of those earnings, of that earnings announcement, right? So both are very, very useful, and they're very, very simple to follow, all right? So now there are many strategies out there and so much to learn about options that it's impossible for me to teach you everything here. It would take many, many hours, but what we've done is put together a course known as the Crush the Market with Options Pro class. And this is a 2.5 hour on-demand training course that we'll send you. And if you go to tradingwins.com/crush, that'll get you to this page here with all the details of what comes included. Now, during this class, I'm not only going to teach you some of the basics, but I'm going to go into some of the more complicated strategies. And I'm going to teach you one that takes advantage of that opportunity that's presented to the sellers, to option sellers. Remember, as soon as you sell that position, you have a 4 out of 5 chance of making money. Well, I'm going to show you a way where you can create a steady weekly income using credit spreads. All right. And also, one of the more sophisticated strategies that most options traders stay away from are known as butterfly trades. And these really give you the opportunity to make 10 times what you're risking. So remember on that example, we showed about $88 of risk, you know, $88, $90. I'll show you a way with a butterfly spread where you can turn that $80 or $90 into 1,000 with these types of trades. And they happen fairly regularly. Also, there are times when the market goes kind of flat. That's when you need delta neutral strategies. So these are the types of strategies that take advantage of options and allow you to make money even when that stock moves sideways. So the longer it stays sideways, the more money you make with these strategies. I'll teach you a couple of them. And also, and what I think is most important, are repair strategies. Because, you know, you're not going to be perfect. No one is. And you are going to enter positions that go against you. But when they go against you with options, as we like to say, you have a lot of options. There are many ways that you can adjust those contracts and repair those trades. And I'm going to teach you a couple of those in this class that are going to really help you out no matter what strategy you use to normally trade with. In addition to that, we're going to give you a 30-day membership to our pro service here at Trading Wins. What that includes is nightly videos from me every Sunday to Thursday. So 5 times a week, I will send you videos. In those videos, I'll talk about what happened that day in the markets and where I think the markets are going. But it's also where I share all my trade ideas from the various strategies that we have. Also, twice a week, we meet and we have what we call live market chats. That's where all the pro members come into our room and can ask me any trading related question you like. It can be on anything. I'm just there to help you become a better trader. And also for our pro members, we do what's called a course of the month every single month at no extra charge. So you're going to get that as well over the next 30 days. All right, all of that for just $7 here. Go to tradingwins.com/crush. And as usual, we like to do something special for the folks here at Investor Inspiration and everyone that joins us for these calls, because they've been such a great partner for us. So just $7 gets you all of this.